A very good evening and warm welcome to the NUSS webinar titled New Economy Investment Forum. This webinar is jointly brought to you by the NUSS Intellectual Pursuit and Lifelong Learning Subcommittee and the NUSS Business Connect. My name is Ita, chairperson of the NUSS Business Connect, and I'm delighted to introduce you our moderator for this evening, Mr. Guo Longjin. Mr. Guo is the legal counsel of APAC Liva Nova Singapore Private Limited. Longjin heads the legal and compliance affairs for APAC at Liva Nova, a global medical technology company. Longjin previously led a commercial, legal, and compliance team at Global HQ for Kulik & Sofa, a NASDAQ-listed company, and has a wide range of experience in private practice, including corporate, finance, and litigation. Longjin holds a Bachelor of Laws with honors from the National University of Singapore and Master of Business Administration from the Singapore Management University. And together with Mr. Guo, we have invited two industry experts to join us this evening in our discussion. Our guest panelists are Dr. David Wang, Chief Operating Officer of Really Singapore Private Limited, and Mr. Thilan Wickramasinghe, Head of Research and Head of Regional Financials at Maybank Kim Eng Singapore. He's also the co-founder of Create Lab. It is our honor to have these three gentlemen here with us tonight to share with us their professional perspectives on how traditional industries can leverage the latest technology to meet the changing demands and challenges of consumers. I'll now hand the time over to you, Longjin.
Thank you, Ita. So before we begin, please let me introduce some house rules for the session. So first of all attendees will be muted throughout the session. If anyone wishes to ask questions at any time during the webinar, kindly click on the Q&A icon at the bottom of the screen. If possible, please keep the questions brief. We will also then address as many questions as possible during the Q&A session. Now, let me introduce the next distinguished speaker, our panelist, Dr. David Wang. He is the Chief Operating Officer and co-founder at Really Private Limited Singapore, which is Asia's leading integrated property management platform with integrated B2B marketplace. Prior to this, Dr. Wang held senior positions in both private and public firms, such as Singapore's Press Holdings, Singapore Airlines, the Economic Development Board of Singapore, and Cadbridge Private Limited, covering roles related to technology, real estate, and investment. As adjunct faculty at SMU, he also remains research active with collaborations in topics on real estate finance, wealth management, technology, and behavioral economics. Dr. Wang will speak to us on the impact of technology on investments in various areas such as private equity, real estate, and blockchain. Over to you, Dr. Wang.
Hi, good evening, everybody, and thank you to NUSS, and also thank you very much, Longjin, and also Ita for introducing the forum and inviting me to this session to speak. Without further ado, I'm going to share my screen so that we can begin the session and proper. So I'm going to go through a very quick synopsis measured in two parts. And what I'd like to do is actually talk about some of the investment themes available to investors in the market today in what we call the new economy, which is, of course, primarily driven by a lot of technology, and also of course, some changing, consumer or investor trends, as well as what is a potential new way for you to invest in this new economy. So that's a broad outline that I'd like to cover. Okay. So let's go through 5 different investment themes for 2021. And one thing that we all have seen in the past, I think 1 year, 1.5 years, is at least the COVID situation hitting us in 2020, as you can see from this red circle down here. But realizing very quickly that even with that crisis, we didn't really suffer a severe market or prolonged market correction in terms of the stock markets. So we found out that stock prices can still rise despite the real economy undergoing some severe challenges. As you can see, like for example, even a lot of articles coming out, even with the UN News, stating that unemployment could potentially rise over 200 million mark. Now, all this is really, I think most observers or market practitioners will attribute that to very supportive fiscal policy, which has supported the market momentum upwards, and we still see stock prices rising today. But having said that, there may be other themes that you might want to consider when you want to participate in the stock markets. And with this backdrop of a really strong stock market, driving that view. So one investment theme I'd like to suggest for our investors to consider in the economy is fintech. So I think a lot of us are exposed to digital payments in our daily life. For example, if you see Grab and using Grab to make payments for your taxi, for your transport, down to your food and so on, you probably have interacted with digital payments to some measure. And I think that will only begin to dominate more and more lifestyles, especially when we see Generation Z really taking that to the extreme, because everything that they do is highly connected with technology. So we think that, for example, some of these trends in digital payments will continue, and things like biometric authentication, EMV, which stands for Europay, MasterCard, and Visa technology, or even mobile point of sale, mobile wallets, contactless payments. Firms that have these types of tech will probably start to and continue to prosper. So I took a very quick snapshot of what you would look at in terms of the kind of startups that are playing in this fintech area. But this is a map, not of Singapore, but of Vietnam. And just to show you how diverse the startup scene already is for fintech in Vietnam. And you can only imagine how diverse that is if you go to other countries like the States, Singapore, and so on. Another investment theme I would like to introduce also is the rise of the conscious consumer. And I think a lot of us have really been startled by some of these new innovations, especially I think the one that's come to a lot of people's attention is the replacement of meat. And for example, this points out to the trend where a lot of people are talking about more sustainable type of food and more sustainable and healthier ways of consuming produce. And all these investments are coming in the form of like plant-based diets that actually cater to this new trend whereby investors are looking for something that would really point towards very supportive or sustainable themes, whether it's in the production, the consumption, in the economy. And this can be from a diet perspective, packaging perspective, even agri-tech, so we can produce more food in a more sustainable way with greater volumes, with less dependency on pesticide and chemicals and so on. So that's another theme that would be very, very interesting. And you can actually point out to two articles that came out, one even in the local Straits Times, that talks about how even cultured meat that's grown in a lab will potentially become mainstream in the future. And I think that we have heard about startups receiving huge amounts of money to really actually foray into this area of business. Other theme that I'd like to bring up is health tech. So I think health tech has already grown even before COVID-19. Health tech usage has grown almost 4 times, as noted by Google, Temasek, and Bain in 2020 in the report. And what's very interesting also is that it has also retained its users post-lockdown. In other words, the use of health tech, whether it's robotic surgery or AI-driven radiology, where you don't really require a radiologist anymore, where you can find actually software programs actually producing better analysis of radiological scans and so on. This type of tech in healthcare driving forward, investments also in companies in this area. I think of late, a lot of us has actually seen a lot of discussion about how any healthcare company, a drug company that's related to some way in producing vaccines, has seen tremendous run up in their stock prices, especially if they are listed. But I think that what is really nascent in the sector is that a lot more of AI being used to discover new drugs is actually going to drive that new investment theme. And a lot of startups, interesting startups are starting to appear on that scene. So predictive healthcare analysis or even longevity tech, how do you help people stay healthy longer and live longer, may potentially become mainstream consumer technologies. And this is something that will be very interesting in the new economy, especially when we see a lot of countries' demographic profiles start to age much more in the future. Now, the fifth and not least, but perhaps is PropTech. Now, PropTech is very interesting because it leads the world's biggest asset class in real estate. And I think Forbes puts out a very nice way to describe the opportunity, where global real estate is the largest single asset class in the world, valued at around 230 trillion. And that makes it a no-brainer that PropTech innovation has a key stake in the world's future. So I think when we look at PropTech, what's really attractive about PropTech or real estate technology is that we can relate to real estate technology quite easily, because all of us are exposed to real estate in one way or another, whether we are at home or whether we go to offices or we go to the malls. In one way or the other, we are interacting with real estate, and we will become more and more exposed to how interactions in the real estate arena will change and become guided more and more by artificial intelligence, predictive big data analytics, and so on. So this is becoming much more interesting. You can have cloud-based real estate management, predictive real estate maintenance, and also potentially real estate AI or even real estate valuations, as we see in the local scene, where we used to have, for example, a listed company, a listed listing exchange called SRX, which actually provided automated valuations that has since been acquired by 99.co. So that's very interesting. And I point out also a company really, this is the company I'm at, that's also participating in this real estate scene as a PropTech startup, and now diversifying into many different areas of automation and AI-driven for software for real estate. I would like to also cover, this is not so much a theme, but an observation. And this is where a lot of investors have talked about where are the market opportunities due to the pandemic that we're seeing. And I think that it's quite interesting because if we refer to a third-party report like Global Business Intelligence, then they identify 6 different sectors that are likely to thrive because of these the pandemic that's hurting a lot of different economies. It's really primarily built around the fact that these startups or these companies are providing solutions to companies, to nations to fight the pandemic. And these could be things like, for example, doctor on demand apps, smart robot makers, remote meetup solutions, biotech businesses, and even streaming services. All these, if you think about your Netflix, or if you think about how even trading platforms have become much more well used and gotten a lot more new subscribers lately, because a lot more people at home are now interested in trading in the market. They have benefited from the fact that a lot more people are staying at home, or they may require some of these services to be delivered digitally. Okay. Now, having said that, a lot of this is interesting, but how do you participate in some of these opportunities, especially when a lot of these investments seem to be in startups or seem to be in companies that may not be listed on the stock exchange? Then I want to point you to how you may participate in such opportunities in the new economy. But first off, I'd like to talk about blockchain and see how blockchain can actually help you participate in the new economy for investments, for investors. Now, I think most of us understand what is blockchain, because blockchain has received a lot of attention, especially when we talk about things like Bitcoin. But the blockchain is essentially a ledger technology where you can actually record all types of transactions in an immutable way, and everybody who has access to that blockchain is able to confirm and verify transactions that have taken place before. So this distributed ledger actually is a database that can be referred to by anybody who has permission to access that blockchain. Now, this creates a lot of opportunities, but I'm not talking to you about it from the perspective of a cryptocurrency like Bitcoin. Now, this slide, I just wanted to point out to you that if you're investing in Bitcoin, I just want to caution you that in the new economy, yes, some people do consider Bitcoin an asset. Some people do consider it just really very speculative in nature. And if you're looking at the chart on the right, you can see how Bitcoin may have really just dropped from just over 60,000 US dollars down to its current price of less than $35,000 now. So this is highly speculative, and I would encourage you, if you are looking at investments, as a traditional investor looking for long-term buy and hold, please do consider the risk of Bitcoin very carefully. But having said that, I'm looking more at the technology behind instruments like Bitcoin as a new way to participate in the new economy. And this is where I want to show you how blockchain is already being used by capital markets to actually organize different things like what we call private exchanges. Now, private exchanges are very interesting because it gives investors more access to private equity markets. Now, if you think about the stock market is your public equity market where you can participate in and buy and sell shares in small units of a large listed company, like maybe Singapore Press Holdings and so on. But if you're looking to buy small parts of a private equity placement, typically in the past, a lot of these investments were only available to high net worth investors or specialty houses like family offices and so on. But that is becoming disintermediated because of new technology like the blockchain. And what happens now is that you can have blockchain powering private exchanges where now private equity is traded on that private exchange. So I want to point out to you the Cabbage Group. The Cabbage Group is a local Singapore company, and it is also the world's first privately organized exchange that has a license, RMO license to organize a secondary trading market for private equities. Now, what that means is that you can now trade the equity or the shares of a privately held company if it's listed on the one exchange. Now, this is very interesting for investors because what that means is that you can now partake in some of these innovative and interesting startups that are not normally available to investors at large. And for example, they may not be listed on the stock exchange yet. They may be raising funds, but they are able to sell shares to people who are qualified to actually invest in such private startups. And this is where there is now a platform within even Singapore in your backyard that is qualified by the MAS to actually participate in these kind of private equity offerings where you can trade in and out of your share positions for such privately held companies. And that gives you access to some of the investment themes that I mentioned earlier on. So having said that, talking about the different investment themes and also a new way to invest other than the public stock market, you can also go to the private equity side of things. I just want to point out one thing about diversification. And this is also where investing in the private equity market becomes very interesting, because if you look at how, at this chart, the vertical axis talks about how much return you can achieve with a portfolio, and the horizontal axis talks about how much risk you have with the portfolio. And you notice that these different pie charts here reflect different amounts of bonds, stocks, or private equity. And then you notice as you include more and more options to take on private equity, then you may be able to achieve a lower risk in your portfolio while achieving a better analyzed return. Now, this is according to a study that was done in 2009 by this gentleman, Neuberger Berman. So this is where it becomes interesting if you want to consider some of these exciting investment themes and also the new channels in which you can invest in the private equity market. So with that, I just want to thank you for this opportunity to share this information with you. Thank you very much.
Thank you, David. Thank you, David, very much for your speech. Now, yes. David, we will move on to the next panelist, Mr. Thilan first. So let me introduce the next speaker, who is Mr. Thilan Wickramasinghe. He's the head of research and head of regional financials at Maybank, Kim Eng, Singapore, and he's part of the ExCo and contributes to driving the group's sustainability strategy, new product development, and innovation integration. He has also nearly 20 years of experience working with HSBC, CLSA, Credit Suisse, advising investors in equity research and market strategy. At the same time, Thilan is also the co-founder of Create Lab, which is a regional edutech startup. He contributes to their business strategy as Create Lab executes its mission to equip teachers and students with 21st century skills through award-winning online and offline content and platforms. Now, Thilan's presentation will focus on the Singapore economy with a view of current trends such as inflation and also on key sectors such as banking and education. Over to you, Thilan, please.
Thanks very much, Longvin. It's a pleasure to be here today. So I just want to say thank you very much to NUSS for inviting me this evening. So Davin talked a lot about what's going to happen in the future. I'm going to talk a little bit more about the present, and I'm going to do that as I share my slides here. So I'm going to talk a little bit about Singapore and the economy and where we are headed over the next 10 minutes or so. I'll talk a little bit about the macro outlook. I'll spend a bit of time talking about inflation, given this is a very broad and very important topic at this stage. And then I'll talk about the different sector outlooks as we go through the next 12 months or so. So from a macro point of view, we are actually quite bullish on Singapore's recovery going into 2021. We are making very good progress in terms of vaccine rollouts. Even if you look at the MAS guidance and things like that, things are quite bullish. Obviously, there's a price to pay for that with inflation. We're starting to see a recovery in the job market. And if you look at how the government is spending their budget, last year we saw a significant amount on pandemic control as well as supporting the economy. Now we are looking at more the government coming in to restructure the economy, driving innovation, as well as themes like sustainability as to take Singapore forward. So for this year, we're looking at a GDP growth rate of about 6.2%. This is slightly higher than what the Ministry of Trade is guiding, which is at the higher end, about 6%. We think quite comfortably, even with the heightened alert situation that we are in, Singapore can quite easily hit these numbers. Obviously, the cost of that is high inflation. We're looking at headline inflation reaching about 1.3%, some of the highest numbers we've seen in a while. But interest rates will remain low, and we'll continue to see the US dollar rate also remaining relatively under control. Now, a large part of the reason why we are bullish is these two charts. If you look at the rollout of the vaccinations in Singapore, we're already close to about 40% of the population receiving at least one dose. Singapore will be the first country in Asia to reach herd immunity. I was speaking to a client just this morning who's in the US, and they were saying, life in the US right now is almost like the pandemic did not exist. And I think, we probably will get to a similar sort of situation as we progress with the vaccine rollout that we are seeing at the moment. We've already started to see some of the signs of it. We saw in the first quarter itself, GDP having a very strong V-shaped recovery. And if you look at the right-hand chart, what's quite interesting is if you look at the past crises, Southeast Asia and particularly Singapore went through, most of the crises were manufacturing driven. So we saw a collapse in global demand and manufacturing. This time around, it was very unique because we saw a services driven recession. While the manufacturing engine actually continued to hum along, even through the circuit breaker and all those issues that we had. And that actually enabled Singapore to have a pretty decent base in terms of overall growth, even during the pandemic. We are starting to see on the manufacturing side almost V-shaped recoveries. The semiconductor exports have seen very significant pickups. And if you look at Singapore's semiconductor manufacturing space, a lot of it is focused on wafer equipment manufacturing. So the global chip shortage and things like that actually is supportive overall for the overall growth prospects of Singapore. We've also seen a very strong pickup in terms of overall exports as well, partly driven by the electronic space, but also from pharmaceuticals as well as other oil and gas products as well. And at the same time, on domestic front, we've seen a V-shaped recovery in property, largely driven by very strong liquidity in the system. Property prices are seeing very decent sort of improvements from where they were. And a lot of people stop me here to ask me the question, do you think the government's going to step in and start cooling things down? My view is that they won't at this stage. If you look at a lot of the transactions that are happening right now, most of them are local driven. It's not foreigners who are coming in to buy. And a lot of it is actually driven by domestic liquidity as opposed to debt. If you look at mortgage growth, it's hardly seen any movement. So we are not really seeing any overheating within the system right now for the government to actually come in and step in. Normally, the government does that when they start to see when they start to see the debt side overheating, or when you start to see a significant amount of foreign buying coming in. Neither of those conditions are there at this point. Not all sectors are recovering. We see that the more front-facing COVID sectors are still struggling. The left-hand chart shows you the visitor arrivals to Changi, and that's completely collapsed. Hotel occupancy rates are also down, and I think these are sectors that will take a significant amount of time, even with Singapore's vaccine rollouts, to actually fully return back to normal. One of the good examples to kind of take a judgment on the speed of economic recovery is mobility, and we do see mobility hasn't fully returned yet, except for maybe people doing. I'm just checking to see any questions here. Okay. Except for people running to the supermarkets. Generally, mobility is still a bit below what they were pre-pandemic, but we're starting to see improvements, particularly with workplaces as well as recreation and things like that. Obviously, the last few weeks of heightened alert would have brought these numbers down, but generally, I think we'll continue to see upward momentum here. The good news is, I think, we are past the worst in terms of unemployment. We've seen a recovery again in terms of overall employment prospects coming through. A large part of the job losses that happened due to the pandemic, and the biggest part happened in the second quarter of last year, was cushioned by foreign workers and non-residents who took the brunt of the hit. We've also seen that as we go in post the lockdowns, other sectors such as services, which were significantly impacted before, starting to add new jobs. I think we are again on a reasonable trajectory of employment creation. And what was quite unique about this crisis, and again, having lived through the global financial crisis and the Asian financial crisis before that, a large part of the job losses actually happened not at the PMET sectors, but in more on the construction, manufacturing, and F&B sectors, so the lower skill sectors. So the PMET sectors generally managed to keep jobs intact, which is quite important in terms of spending, household spending power, as well as economic recovery. And we are starting to see some signs of recovery coming through. We are starting to see the overall lending side picking up. It's still very early stages, but I think you will start to see that momentum picking up, particularly as some of the other regional countries also get vaccinated, and the pace of that vaccination starts to increase, given Singapore's position as a regional financial center. So I talked about overall Singapore's economic prospects, but I just want to spend a couple of minutes talking about inflation. We are entering a period of inflation which we haven't seen in a long time. So I think for a lot of people, this is going to be unfamiliar territory. Headline inflation's already accelerated in the April numbers to a 7-year high. And I think that's still going to, the pace of that is still going to continue. A large part of that is driven by the food and energy prices. Already food prices are up about 40% from last year. And we're also starting to see oil, palm oil, a lot of the other commodity prices also having very strong recoveries. Soybean oil again is at a record high at the current at today's closing. So I think overall inflation is going to come, and it's going to be something that's going to live with us for a while. Part of this is transitionary because we are measuring it against a low base from last year, but some of it is actually here to stay. So if you look at Singapore in particular, some of them are cyclical. The commodity prices, we've had some big disruptions in shipping and transportation. We are seeing that housing rentals are increasing, partly because a lot of overseas Singaporeans are returning, expat Singaporeans are returning back to Singapore because of COVID displacements in the countries that they were working in, and that's actually driving rentals higher. And of course, the restrictions that we have in terms of foreign labor as well. But I think, you know, from a more medium-term point of view, you're going to have structurally higher inflation. We are going to contain overall foreign manpower availability in Singapore. We are expanding minimum wages for different segments of society. Tech is not deflationary anymore. When you buy stuff from Amazon, it is going to get taxed, and that's going to drive overall pricing there. And I think we're also going to be living in a higher tax environment. We have the higher 2% GST hike, which will most likely happen in 2022 rather than 2023. And also higher potential for higher personal income taxes and wealth taxes, and especially with the recent G7 announcement of a minimum global tax. So having said that, I think interest rates will remain a little bit low, which is supportive for overall capital markets. I think we'll only start to see some real tapering happening with the US Fed taking a little bit more stricter decisions on where they want to see interest rates going. And I think the overall recovery still is too early stages to take very strong decisions on hiking. So given that fact, I think MAS will generally remain fairly neutral in terms of where they keep the currency, although there's a slight risk that they might appreciate it a bit if inflation starts to get a bit out of hand. Now, I'm just going to put this, this is my last slide. I'm just going to put this up on the screen in terms of overall investment positioning that we're looking at for the Singapore market. We are generally quite positive on the banking sector, given given improvements in loan growth, margins, as well as potential write-backs from allowances. We're quite positive on the telco and media space, particularly given the sort of restructuring that you're seeing in the GLC space, particularly for Singtel. We are positive on the healthcare sector, largely driven by COVID testing and a lot of the COVID responses, but also I think this will be one of the first areas that you'll start to see some opening for medical tourism and so on. We're very bullish on the technology sector as well, largely driven by Singapore's gearing towards the themes of chip shortages, as well as a lot of new products that are coming out in the semiconductor space. You're a little bit more cautious on more COVID front-facing sectors, such as gaming, some of the industrial names, which are very much linked to aviation, and some of the property developers as well. With that, I'm going to hand back to the panel.
Okay, thank you very much, Thilan, and for your very interesting speech, especially the part on inflation. I really thought that was very illuminating. So now we will move on to our Q&A session. There have already been a couple of questions that our participants have typed out. I encourage all participants to ask more questions if possible. We do have quite ample time, which is about 50 minutes, for question and answer. So as the questions go, I'll direct to the two of our panelists, but either of you, feel free to jump in anytime with any answers or feedback that you might have. So I think the first question comes from Mr. Lim Chi Kiong. That's, I think, probably directed more towards Davin, right? He mentioned that 20% investment in private equity may not be suitable for everyone because investors need a much longer investment horizon, and they may have a really relevant risk profile. Yep, Devin, could you share your thoughts on that, please?
Yeah, sure. Thanks for that question, Mr. Lim. And I agree with you that with high risk comes high return, or vice versa, right? So the thing is that it's true that some of these investments in private equity side, especially to the investor who is not good at, or who doesn't have the sufficient ability to actually discern the amount of risk in that investment, then they are actually at a disadvantage. Perhaps they don't have a good team of advisors, or they don't have enough resources or accurate information to gauge the risk level on the investment. Then yes, I agree that even a high reward may not be justified. But at the same time, in private equity, there are quite a wide range of investments. You have investments ranging from technology down to old world real estate. And this is where they are looking to get funding to develop themes that are quite familiar. For example, anything from what we call common housing units down to even like student dormitories and so on. So there is quite a big range. And in that sense, some of the investments do give you a return that's lower than 20%, maybe in the sub tens, definitely higher than a traditional REIT, real estate investment trust that you could buy on the stock exchange. But at the same time, also the investment duration would typically be longer, anywhere from 3 to 4 or even 5 years. So you can find an investment that would probably suit your risk profile and risk appetite. It depends on really what understanding the nature of your investment and the purpose and the end results you want to take, and your comfort with risk. So that's very important as well.
Okay, thank you very much, David. So maybe we can move on to the next question. This is a general question that can be directed towards both panelists. So Takeaway has asked, how do we identify the winners in the tech startup space? I think everyone is very concerned about where they want to invest their money in, right?
Yeah, I mean, sure. I'll take part of it. I'll take part of it from an investment point of view. I do I do advise a few startups as well. So maybe I can give you some background as to how I kind of approach that. And I would say the first sort of criteria for me, more than anything else, even before the business idea comes through, is actually the quality of the founders. I think that is one of the critical sort of differentiation factors when it comes to a startup that can actually make it versus a startup that doesn't. And it really depends on the ability of the founders, and if it's more than one founder, the chemistry between the different founders to actually articulate their idea, and the sort of energy that they bring in, and the level of belief that they bring to the idea. And the second is obviously the amount of ability of again the team to pivot, because every startup that I have worked with, the initial pitch that they make versus what they actually end up doing is very different, because there are multiple pivots down the way. Because when you start the startup, you start with not having all the information you need. So as you build your data and as you build your information, you start to pivot your business model. And I guess for me is how flexible is the business model that the startup has, or is the business model very narrow that it only addresses the problem in a very narrow way. So again, I think that that is a key factor in terms of what is a winner and what is a loser. And then I think the third one is based on financing. I mean, I think coming from a financial background, coming from a banking background, and being a startup founder myself, I mean the rarest commodity for a startup is funding. So in ability to raise funding, for you to have that strong story to raise the funding, and if you can actually get good quality seed investors coming in to support you, that makes a world of a difference versus not having that at the very early stages of a startup. I think if you look at the world today, and if you look at the post sort of GFC period, when there was a lot of funding, lot of liquidity that was available, any idea could get funded. But I think as a lot of VCs and as a lot of private equity, everyone started getting much more narrower mandates. The ability for them to invest have also become narrow. So a lot of them are now investing in companies that already have a certain level of scale. So for you to be able to take a piece of that pie, and if you can get that sort of funding from good quality investors, then I think half your battle is won. David, do you want to add anything to that?
I think those are excellent observations, Dylan, and I agree with you wholeheartedly. In part also because like you, I'm also a co-founder of a startup. So I truly agree with your observations. And I think also from the viewpoint of a startup, it's very important that the problem that we are trying to address in the marketplace has to have enough attention in the sense that people are willing to really spend on this, and there's enough scale of a problem for us to really address. So this is an addressable market, right? And from that viewpoint, it's very important that startups can actually scale the solution across markets, not just in Singapore, but also go overseas and scale. So I think that is very interesting. And on the point of pivoting, I totally agree with Tilan. And on the business model part, I think we see a lot of startups actually trying to reinvent themselves, and even as for example, software as a service or everything as a service is now really the common talk of the town in terms of a business model. And I think startups must be ready to really change their business model to suit and understand the needs of the market at this juncture. And at this juncture, where there is perhaps a bit more risk on the table, a lot more challenges because of COVID, startups that can really ease the transition from market that is actually quite difficult to better times, and has a business model that can support the transition, whether it's from a subscription model in terms of revenue and so on, then these startups are really well poised to take advantage in placing themselves ahead of the competition. So yeah, I think that's my 2 cents. Thanks.
Thank you both for your views. I think very useful, definitely very good factors for us to consider when we are looking at, tech startup space, whether, in terms of the founders, whether in terms of financing, or, whether they're out to solve like real world problems, right, what Devin shared, right? So I think the next question is more directed towards Tilan. I think one attendee has mentioned that, for ample liquidity on your slide, why is that so, and where is the money actually coming from?
Good. That's an interesting question. Yeah. So, I mean, I think Singapore as an international financial center anyway attracts quite a lot of liquidity. Part of that is driven by safe haven status. So if you look at overall system deposit growth that was coming from outside Singapore, it was growing at 40-50% a month for most of 2020. So there was a significant amount of capital deposit flow that was coming into Singapore. So that's one. The second is actually FDI. So if you look at the EDB's figures for 2020, which was the COVID year, Singapore actually attracted more FDI than 2019. And again, I think Singapore's sort of international financial center, as well as the sort of jumping board for Southeast Asia, helped. And I think the final is actually the domestic liquidity. If you recall, last year, the government spent 20% of GDP on COVID relief to keep the economy going. 20%, that's the highest in any country in the world. And I think that created a massive wall of liquidity as well. The reason why we didn't go into a more deeper recession, why it didn't turn into a recession, a depression, why we didn't see that many companies folding, the reason we didn't see non-performing loans rising. A large part of that is this liquidity injection that the government did in 2020. So I think all these factors combined has resulted in this liquidity in the system. And plus, obviously, given the fact that globally as well, we've got interest rates coming off quite a lot, and most governments from Europe to the US to China, everyone pumping money into their own economies. Some of it does end up in Singapore.
Thank you very much, Sheelan. The next one is a bit of a general question. So the question is, what's the investment speech that separates the tech sectors from the real industries? I think this attendee probably means the traditional industries, right? So they compare edutech to education, pop tech to real estate, tech versus pharma or healthcare. So if both of you could chime in from your own experiences in the various sectors, that'd be great.
Maybe David, do you want to take it? I can take the edutech bit a bit later on.
Okay, let's do a tag team on this one. So I think when you look at the traditional sectors and say the startups, the tech, in terms of the tech startups that are coming in, there have been quite a few market narratives, if you will. I think one of the oldest market narratives was how to do things faster, more efficient. The whole narrative of disintermediation, that means getting out the middleman, right? So you can drive costs lower or make sure that people are contributing in more valued roles. So these were some of the traditional narratives. But I think as we move along in the last, I think, few years, I think we're seeing a lot of new tech coming in and really disrupting, how people actually do business. Whether it's like, for example, it's the fintech place where how people pay and how these transactions are still fluid. I think even with a Singapore fintech startup called Validus, they have come in and really, disrupted how factoring is done and how quickly they can do it in terms of assessments of people who want to raise, get a factoring arrangement done without any collateral. So I think when you look at some of these new startups that are totally disrupting the old way of doing business, the ways that they wanted to assess whether a deal could be done, how fast they could use big data to assess that, analyze that, apply and offer a solution very quickly, stand in a gap where their traditional players are not able to, then I think this is a very interesting space that separates the tech startups with the old world operators. So that's one. I think this may also be interesting from the prop tech perspective, where we are talking about really living in buildings that are still, for example, using old notice boards. But today we've got digital notice boards, where notice boards can be controlled over the cloud. And you don't need to have a person go from notice board to notice board in every estate. And I still see, when I visit sometimes friends and family in different estates, I still see the old notice boards down there. And I think this is where we can just see there's this whole opportunity in industries changing, lifestyles changing to embrace the tech. And some companies are better situated to help that happen because they don't have any, any old baggage. They don't have existing product platform in which is encumbering them from moving on to the new tech. And this is going to be very interesting to see. So, Sinan, over to you, please.
Maybe just to add on the edutech and traditional education. I mean, what is traditional education? It's a teacher standing in front of a classroom, imparting a lesson, right? And that is how we've taught for decades, the model of a teacher in front of a classroom. And the problem with that is, different students learn at different speeds. They have different interests, but there's one teacher who does the lowest common denominator. But that is not necessary anymore. I mean, we've got technology, we have the ability to collect data, we have ability to analyze, we have the ability to scale. And I think that is the change that we are seeing in the edu tech space. So we have the model is replacing that teacher who is teaching the lowest common denominator of the student to actually giving individualized learning at scale. And you do that by devising curriculums that can be scaled, and you use a lot of data analytics feedback loops to provide very, very precise learning experiences for each individual student. And you do it at multiple cultural contexts as well at the same time. I mean, David talked about the need to scale, not just for one country, but multiple countries. So I think that is what edutech, or I think for a lot of tech sectors, it is the ability to address customer needs in a hyper personalized way, but doing it in a way that you're actually doing it with falling unit costs, which the physical sort of business models cannot deliver. And I think just to add on to that, I think particularly what COVID did really is I call it the great accelerator in a way. It pushed so many people who were reluctant to get on digital platforms to get on the digital platforms. I mean, if you look at just Southeast Asia, something like 55% growth in education, in terms of first-time users of education online. I think about 50% increase in groceries being shopped online. 40% of people using banking for the first time online. So I think it also, overall, this whole pandemic and things like that enabled customer adoption. And I think that is going to help a lot of these tech names to kind of accelerate what they're doing and scale a lot faster as well.
Okay, thank you very much, Thilan and Devin. I'll share a bit on the medtech sector as well, since that's my sector. So I think fundamentally, tech has changed the way that we experience lives, right? So from the medical point of view, I would say, as individuals, it's really the way we experience healthcare and the way that healthcare is actually delivered to us. So for example, now we all know that there's telemedicine. You don't need to go to the clinic anymore to see a doctor. You can do it via app. They're increasing breakthroughs. There are devices that allow remote monitoring of a person's body condition and health. Yeah. So it encourages early detection of any emergencies and stuff like that. Then there are also innovative products that can be implanted into your body to replace failing body parts or even certain functions of your different organs and stuff like that. So for example, my company is actually in neuromodulation, and this is an area where we implant a device into a person's around the arm area, right? And it's basically just a small little device underneath your skin. And what it does is it controls certain conditions, right? For example, like epilepsy, depression, heart failure, and stuff like that. But it is a very new technology that's being regulated, and we are getting the relevant regulatory approvals for it, right? But this is obviously a break away from the traditional pharma industry, where drugs were used to treat the condition. And it's a whole new breakthrough because it doesn't directly affect, you don't need to consume drugs anymore, which may then affect the rest of your body and may have other side effects, and also reaches out to other people who may become drug resistant or actually have very bad side effects from the drugs, right? So I'll just a quick sharing on the medtech area. So let's go to the next question, which is I think there are a few questions about various industries and how both of you feel about the industries. I think one of them is with regards to the property sector outlook. Thilan, I think you already mentioned it just now. And Bharat has asked, whether we expect cooling measures are offering, I believe that you already mentioned that. You said that, there are two conditions, such as whether there's expected foreign investment coming in, whether there's increasing debt, then the government will actually interfere in those conditions, but you don't expect that. Do you have anything more to share about the property sector, Tila?
Yeah, I mean, I think in terms of physical property, I think it's too early for the government to come in and cool. I think, we are just starting to see a nascent recovery, so it'll also be quite difficult to come and cool things down so soon. I think if you look at the sort of property players in the market, I think there'll be a couple of things happening. I think just as you saw with Capital Land, I think with the sort of prolonged cooling measures and things like that, the business model of developers per se is you're not going to generate significant returns in the short term. So I think just like how Capital Land decided to privatize their developer arm and mostly focus on their REITs business, I think you might see that sort of corporate restructuring in some of the other developers as well. I think the REIT sector in Singapore has always been a very large sector, a very well followed sector, and I think that ecosystem will continue to grow. I think especially the sector such as the industrial REITs are very, very strong themes to play e-commerce in Southeast Asia, are very strong themes to play the whole data center explosion that you're seeing. So I think you'll continue to see more deals happening in that space. I think there's quite a lot of liquidity that is going there as well. And I think a lot of the uncertainty that was there in terms of DPUs last year, the rental reliefs and things like that, I think they're moving away. So I think the industrial REIT side will do particularly well. The retail REIT side as well, I think we'll start to see some improvements. Heightened alert notwithstanding, I think as Singapore opens up, you'll start to see that happening. I think where you have some of the biggest shifts though is the office REITs. I think the way the relationship we have with officers is changing. I mean, even before the heightened alert, when the government said 75% of people can come back, I mean, I know in Maybank, most people didn't want to come back. Right. So I think the sort of relationship that you have with officers will change, and that will have impact in terms of, overall floor spaces and how offices are used. So I'm sure David has more comments on the office space than I do. But yeah, so I think those are the two shifts that are happening. And the developers, I think you'll see more restructuring. I think you'll see more deals happening in the industrial space and also the retail space.
Thank you, Thilan. I think the next question also about the sector, but this is about the aviation sector. Someone asked actually about SIA quite specifically. Now I know you mentioned, Thilan, that we are expected to have herd immunity in Singapore because we become vaccinated and stuff like that. So do you think that the sector for us, do you think SIA will do very well in the next year or so?
I think it's a recovery play, but I think it's not an immediate recovery play, and the reason is, although Singapore will have herd immunity, you will still have the region has a significant way to go to catch up, and I think Thailand only just started their vaccination program, for instance. Indonesia is only just moving to mass vaccinations. So I think a lot of the inter-regional travel will remain delayed. And I think even though the population has herd immunity, whether Singapore will go to open borders very liberally is questionable. I think even if you look at the European Union, where vaccination programs have been pretty advanced, and even there the interstate travel is still relatively slow. There's still restrictions in place. I think from a capitalization point of view, Singapore Airlines is definitely one of the better capitalized airlines in the region. I think the recent convertible bond and all those things puts it in a very strong position. I think in terms of what will open up first, it will be business travel more than tourism. And again, Singapore Airlines has a very strong product in the business travel segment. I think again, the overall cargo business should be doing quite well as well, particularly given the fact that there's a lot more vaccination needed around the world, and I think Singapore Airlines has the capability to deliver that. So yes, the short answer is yes, you should be looking at it, but I can't tell you the timing. I think it'll be some time.
For the long play, right? For the long future. Okay, so maybe Thilan, we will give you a bit of a break first. The next question is quite a general question. So Devin, if you could take this. So it's a question that I'd love to know the answer to as well. It's the question is, if you have the last 10 grand, $10,000, which sector would each of you invest and why? In today's context, is there a difference between investing in startups versus traditional companies?
Okay, so this is a crystal ball grazing question, and with one leg in. It's a show hand question, I guess. But I think the way I like to take the question is, if I look at a sector or a trend that I believe has got very strong fundamental macroeconomic forces driving that trend for at least a few good years. And one thing that I like very much is the commodity cycle. So I think this also came out in Thilan's presentation, which I strongly agree with, which is also driving inflation. But on the commodity side, what's very interesting, and this is not new tech, but this is really related to this, narrative about supply destruction. In the fact that the last 2 years, we've seen the economy go down. We've had a crisis with COVID, and a lot of travel has been stopped. So in that way, you can also relate that to what happened in aviation. A lot of sea travel was stopped. A lot of consumption in offices and cafes went down. So overall, in terms of energy commodities, a lot of demand was also went down. Prices, if you recall, last year in 2020, we saw negative oil prices, for the first time in many years. So what that led to was an unraveling of the energy sector. And in that sense, a lot of new wells were not developed. A lot of existing wells were closed. And you had a lot of supply destruction in the energy sector. And I think that this is really going to drive oil prices to a real high. And I wouldn't be surprised. I'm not sure how many on this forum recall the time when oil prices hit over $100. And I think that was just in about 2008, 2009, we saw that cycle. And I think we're due for another super cycle up in commodity prices. But having said that, there's also a flip side, because I want to connect it back to the forum's theme of new economy investment, right? Which is also the case whereby you're seeing a lot of discussion about what is the future of energy. And this is where we're talking about renewable energy sources, the use of electrification of grids, the use of electric cars, and all these things are coming up. Even, I think, a very popular topic is also one of Tesla, where the richest man in the world, Elon Musk, he became the richest man in the world because of Tesla. So I think these are the flip side of that energy narrative. As you see oil prices going up, I think the world has also decided very firmly they need that alternative to natural fossil fuels. And this is where the electrification of the grid and all these other supporting infrastructure will become interesting. From the perspective of Singapore, I think it's also interesting that our government has actually, spoken about how they are willing to allow new debt to be formed to support infrastructure investments. And this is like the bonds that would support infrastructure investments. And I think a lot of this will have to do with, really changing the way Singapore consumes energy. This is going to be a very interesting opportunity, especially if you look at firms that support this whole wave in electrification and so on. So that's just my 2 cents for the last 10 grand that I'll play in. Thanks.
This is perfect, Devin. It actually leads us, right nicely to the next question, which is, what is your take on investment in environment, social, and governance sector? We all know that sustainability is the current trend, right? And what is your strategy to invest in the sector? Do you have anything that you would like to elaborate a bit further on the ESG sector?
Well, I'd like to elaborate on it from the concept of, I think how companies see it, right, in terms of this opportunity. I think ESG classically has always been an investor-driven narrative, I feel. And I'll be happy for Tilan to comment on that, where, investors really, there is a group of investors that are really willing to participate in investments that have that focus, and not just commercially driven outcomes, but also the fact that they're doing something that really benefits the environment or benefits a social sector or group of people. And I think that's very admirable. The key question or difficulty becomes balancing optimizing commercial outcomes and also that ESG mission. And I'd like to refer to this part, which is where we talk about the debt market, in capital markets. And what's very interesting, loosely connected to the ESG theme, is the fact that green bonds have become very popular of late, even for institutional investment. And I think for certain persons who are, have access to participate in some of these types of investments, like even in a green bond or a green bond related investment fund or ETF, these are interesting opportunities. And you can see that our local real estate companies like Fraser's Properties or Capital Land, they've been very active in using green bonds to raise financing for new ventures as a form of debt. And the green bonds are interesting because they are really capital that's raised to actually help fund projects that are also going to follow certain guidelines that actually show how, in these cases for the property sector, that the buildings that they're building or the projects they're building are going to be a lot more environmentally friendly or energy friendly as well. So this is another interesting area that you may want to consider as well. Thanks.
Thank you very much. So maybe we can go on.
Maybe I just want to add a couple of
yes, please.
Thoughts on this. This whole concept of companies being run just for shareholder return is a fairly new concept. It only really started coming up in the 60s with the efficient market hypothesis and all that sort of stuff. I mean, before that, historically, companies were actually run for multiple stakeholders, right? It was supposed to be part of society. So I would say this whole sort of ESG trend is actually kind of returning to mean. If you ask even 2 years ago, when I spoke to clients, no one asked me about ESG. But today, when I speak to clients, every single one of them ask me about ESG. And just as they ask me what is the ROE of this company and the PE of this company, they ask me about what is the governance track record, what is their emissions, right? And the reason why they're asking these questions now is because of how capital is being allocated and how wealth is being allocated. There are on the institutional capital side, a lot of the mandates that are coming through are coming with attachments to ESG, right? So a lot of fund managers today are being told by their funders, the people who give them capital, that they want sustainable outcomes. They want outcomes that are within planetary boundaries. And the second driver is that there's this massive wealth transfer that is happening from the boomer generation to the millennials to Gen Zs, right? So suddenly a lot of family offices, private wealth, it is the younger generation who are inheriting this wealth, who see the world differently. And they're asking their bankers for more social causes when they invest. Right. So I think that is a mindset shift that has happened. But I think from a much more broader sense, I think the way we have been investing is not sustainable. right? The way we have been consuming and investing and looking at returns is not sustainable. And I think that realization is there in the market. So, I mean, even if you look at a bank and the way they look to lend today, they don't go, oh, we only want to lend to ESG, or we don't want to lend to this sector or so on. They look at it from a commercial point of view, and banks have realized that giving a loan to a company that is responsible, right, means that there's a higher chance that they can recover that loan over a longer period of time, because a company that is responsible, that can guide their business within the planetary boundaries, means that that company can survive, versus a company who is just doing business as they always did, driving up emissions and things like that, because eventually capital is going to dry up for that company, right? So a lot of investors don't want to be the last person holding on to those assets. So I think that shift is happening, and I think that's going to be a very critical theme. And I think it will not be called, I think even in a few years from now, it will not be called ESG investing. It'll just be called investing.
Thank you very much, Thilan. Just nice, I think there's a next question, which is with regards to inflation. I think Mike has asked, he says that he understands that inflation will go up in the longer term. He's wondering whether you can share with us how high it could go up in 3 to 5 years from now, based on prevailing and historical data.
Your guess is good as mine, but I think we're looking at about 1.3 for next year. I think you probably can touch 1.4, 1.5 as we go into the following year, especially if we continue to see commodity prices rallying quite hard, and if the world doesn't really recover from COVID. And I think a lot of these sort of displacements that are happening in the supply chains and things like that is because of COVID. I mean, just today, China's had a cluster in one of their port cities, which has led that port to be closed, which again is going to disrupt overall output. So I think you're going to see this sort of issues happening. But I think at the same time, there is significant amount of tools that the governments can use. I think if the recovery is in a slightly better footing, you may start to see, interest rates coming back up a bit more. And I think there is some consensus moving that way. So I think that will be a possibility. I think central banks have generally become quite good, particularly over the last 10 years or so, to target inflation. So I think it's not going to be a situation where it's going to be completely out of control. I mean, even for Singapore, the MAS has ample room to manage and tighten a lot more than it's not done any tightening at the moment. So it does have a lot of room to do that.
I think it's interesting what you just mentioned about the expectation of interest rates in the next few years. I think the next question just happens to also be about investments, right? And talking about interest rates as an assumption. So I think both of you can probably share on this. So the next question states that with interest rates at an all-time low and expected to remain low for a number of years, does it still make sense for the overall portfolio to retain bonds investments at 30% of the portfolio?
If I may just take a stab at that first, Dylan, before I hand it over to you, but I want to connect it with your earlier comments, which is it's on the inflationary aspect. And I agree, like you, I don't have an idea how high it can go. I don't think anybody can give a figure, but we can probably get a hint of the direction of which inflation, and right now the direction is up. That's clearly the case. But I also want to add in a little caveat, an alternative way to thinking about inflation. And I bring us back to financial history. If you look at the 80s, I'm going to ask a simple question that I ask sometimes in some of my students in the wealth management classes I talk about. Do you recall what was the highest savings rate you got in your Singapore savings bank, your deposit bank account? Do you recall what that highest savings rate was? And if you talk to perhaps, people who are more elderly in your family, people who have been actively commercially since the 70s or 80s, they were going through a period where, even the interest rates in your savings deposit was about 8%. And if you recall, that happened in the 80s. And if you track that to the markets in the US, and you recall the time when inflation was a raging bull in the US, and the Fed chairman at the time became famous and infamous, and this was Volcker, who actually raised interest rates really to combat inflation. And I bring you to this point because even as we look at investments, we have to be, it's important to be aware of inflation because that's going to drive up prices and that's going to hurt or help some of the performance of the companies that we deal in. But also on the interest rates part, because companies have so much corporate debt, I think that specter of rising interest rates, which seems so foreign today, may come round into the investment picture very quickly. And if you look at the historical rates in the 80s, even in the Singapore scene, when interest rates started to rise, they rose violently. They didn't gradually creep up on a person. They rose very fast in a very short amount of time. So even if you're looking at real estate, or if you're looking at even trading in corporate debt, if you have access to that kind of investments, or even if you're buying listed companies which have a lot of debt, you might want to consider how changing market situations may really affect you. And I thought that would be an interesting point to look at financial history as a teacher for what may lie ahead of us. It's not really different. It's just presented differently. So that's an interesting one. Hand over to Tilan for if you have any views on what I just said. Actually.
No, I perfectly agree with what you're saying. I mean, I think when change happens, it happens very rapidly. So I think a balanced portfolio is definitely something that you need.
That's great. I think one very interesting question has also come up is, cryptocurrency. I think everybody's very concerned about that. So someone has asked, mentioning that the great rise in Bitcoin prices and other alternative currencies may have left traditional investors scratching their heads. So no matter which camp you find yourself in, it is now nearly impossible to avoid talking about Bitcoin when it comes to investing. And they're asking for both of your comments on this.
Okay, let me take a stab at it. I mean, so Bitcoin and all these alternative coins and everything in between, they're extremely frothy. There's a lot of uncertainty. There's quite a bit of retail euphoria that is there as well. But I'll tell you one thing that is different versus say the 2018 rally that we saw versus the rally that we're currently seeing today is there is the 2018 rally, I would say, was very much just purely retail driven. It was very much euphoria driven. It was the last sort of vestige of all the quantitative easing that was happening for the 10 years before that, after the global financial crisis, and it all kind of ended up there and blew up a balloon. But the conversations around cryptocurrency is a bit different this time around because it's becoming a lot more institutional. So I think a lot of the banks are taking it seriously as an asset class. A lot of the private wealth is also taking it seriously as an asset class. And you're starting to see, again, when you go back to 2018, everyone was kind of scratching their head as to what the use case was for blockchain and everyone. And, while there was quite a lot of euphoria, but no one could really hold on to a real use case, right? The only thing that kind of came out of it was the ICOs, which ended up being generally mostly frauds. But this time around, I think the whole sort of DeFi movement which is kind of innovating new ways to use the blockchain, innovating new ways to use currencies, tokens, things like that, has brought it to the realm of institutionals. Right now, I can tell you pretty much every single investment bank today is looking to put together a crypto desk, right? From JP Morgan to Morgan Stanley to every bank in between is putting together a crypto desk, right? If the banks thought that this was just a passing retail phenomenon, they wouldn't be investing in crypto desks. And I can tell you that, there is a very acute shortage of people at the institutional level who know crypto, right? So I think so this time around, I think there is a much more stronger conversation. I think use cases are starting to come through. What the right price of Bitcoin, I have no idea. That changes every minute. But I think as an asset class, it is something that I would definitely keep an eye on. And disclaimer, I do have investments in it too, simply because I think I am convinced that there are use cases for it now versus even 2-3 years ago.
I just want to add to the comments on cryptocurrency, and I have a much more naive view about cryptocurrency. One thing is I wish I was smarter and taken some positions in cryptocurrency like you, Dylan, many years ago when I first heard about it. But I don't deny that the markets are seriously looking at participating in the cryptocurrency market, right? From the banks to the retail side. I think for me, what I look forward to seeing is more government participation in crypto. And I look forward to the day that you can really pay your tax bill with a cryptocurrency, a sovereign cryptocurrency, because that would tell me that there is real recognition and a formal, a recognition of that asset class, in which you can actually trade and maybe, use this for cross-border trades and so on. So this is an issue which I find still not fully answered, at least in my view, in understanding the crypto markets, the authenticity of it, who provides authenticity to crypto markets. I think a natural market participant would say the market does. But at the same time, you can see that from even the Chinese actions on regulating the crypto market, that a regulator can really throw that into upheaval. That's one. And then number two, I recall having a chat with a market observer, and we were discussing, how Bitcoin reacted after Elon Musk tweeted some comments on what he thought about Bitcoin or some cryptocurrency, and the cryptocurrency actually moved tremendously up and down based on what he was saying. So the comment that the market observer gave was that how could you really get into an asset class that could be moved by one individual, by the personality of one individual, or the influence of an individual? Should price discovery be market-led? And this is something that I feel there is some way to go. And I don't deny that cryptocurrency is an infrastructure that the world needs, because everything is becoming digital. We just need much more support in terms of frameworks, regulatory and so on, that can support the real embrace of cryptocurrency, which I look forward to.
Yep. So we have about 5 more minutes left before wrap session. So we'll just take a couple of 1 or 2 quick questions. So I think there's a related question to cryptocurrency. I think they're wondering if there's a safe platform that either of you would recommend for cryptocurrency investment, and where they could access more resources to learn about this.
I really can't recommend anything. Sorry.
Yeah, I think the market, just as what Devon said, right, needs a lot more regulation before I think we can even speak of any recommendations of a safe platform, right?
Yeah. Sorry, I have no recommendations either for a platform.
Yeah. Okay, I think there are 2 more questions. One is what is the view of telemedicine? So I'll just quickly address it. Please feel free to chime in if any of you have any ideas. I think obviously it's a very new area, And obviously, I think we all know that COVID-19 has accelerated the need for that as well. As with any new thing, there are pros and cons. Obviously, it gives us a lot of convenience. We no longer need to go to the clinic, spend a long waiting time there, right? And then possibly even fall sick because you're exposed to other sick people in the waiting room as well. And it probably saves your cost because you pay much less in terms of cost. But of course, there are disadvantages. We talk about how maybe healthcare losing the human touch, or maybe on a more practical note, whether assessment can be made adequately by the doctors, right? So just like cryptocurrency, I think we are looking at regulation. The government, MOH actually, I recall, did a sandbox for telemedicine last year, and I think they closed it sometime in February this year. And it is something that I think will definitely gain increasing traction throughout as we go along the next few years. But of course, there will be, without a doubt, because healthcare is always a very sensitive area, there will be a lot of regulation in this regard. Now, I think we can end off with just one very last question, which is just a very generic question where Dr. Jarna is asking, where do you think we can access information, any resources to find out more about startups in Singapore? I think because generally it's harder to find information on startups, right? Yeah.
I'll just give a few pointers, but I think there are a few different online websites that you can go to. First, to find out about startups in general, like Crunchbase and so on, to really just have an idea what startups are doing. And this may not be limited to startups in Singapore per se, because Singapore is a very small market. You might want to explore and look at the regional markets. And secondly, I think it's really better to have a conversation with a startup, especially if they are in the fundraising stage. I think this is where it becomes very interesting, because you get a real discussion and dialogue about what the startup is trying to do, which market they're trying to address, and how they plan to scale their product or platform to really take advantage of capital markets and provide solution out there. And I think this is where you might even talk to like some of these platforms I suggested, like CapBridge, which actually has a lot of startups as investment opportunities on its platform. And you can start talking to these companies that have been already in some way filtered for you because they are ready for investment. And then you can have a very interesting learning journey, and also as an investor, and also just understanding the space you're interested in.
Okay, thank you very much. So I think this concludes our Q&A session, as we are almost at the end of our time. So first of all, a big thank you to both Thilan and Devin for all your valuable inputs. I believe we've learned so much. I have personally really enjoyed this session and learned a lot from it as well. And we would also like to thank, of course, NUSS for organizing this. And we also hope that everybody today, has enjoyed this session and taken away some interesting perspectives, right, from today. Yeah, no, with that, I will hand over now to our MC, Ita.
Thank you, Longjin, Devin, and Thilan for the engaging discussion. Ladies and gentlemen, we hope you enjoyed tonight's session. And before we leave this webinar, please scan the QR code that will soon appear on screen and let us know your feedback. We look forward to having and seeing all of you at our future webinars, and hopefully soon we can revert back to live on-site events. Meanwhile, stay safe, everyone. Take care and have a good night. Thank you.
Thank you.
Thank you very much.
Thank you.